What if I told you in buying your next vehicle, you could have the same exact payment as what you would going through a traditional lender, but pay off your vehicle months early and save thousands of dollars of interest? Hey, y'all, and welcome back to The Real Money Talk, where we get real about how money actually works so that you can make better money decisions. My name is Erica Neal. I am an authorized infinite banking practitioner, wealth strategist, business owner, and investor. We're going to dive deeper today into how does an infinite banking policy loan work compared to a traditional outside lender loan, and helping you have a better understanding of why people are using these policies as their own private bank instead of having to pay cash or go to an outside lender. This actually happened this week. It's happened a few different times, but it happened this week, and I was like, you know what? I need to make a video out of it. It seems to be a recurring thing. And so I want to make sure and share with you guys the power of becoming your own banker, taking advantage of policy loans while still being able to fund your business, to go buy equipment, to go buy more property, whatever it is. But today we're going to talk about the loan process and what that looks like becoming your own banker so that, again, you can make better money decisions. Let's get into it. Okay, so here's the scenario. I have a client. They have their policy. They have cash inside of their policy, rocking and rolling, okay? They went to go buy a new vehicle for their business. And this vehicle costs about $67,000. So they chose to, because a lot of times when you go to a dealership and you're buying a vehicle, they will give you special pricing for if you finance through us, we'll give you, however much off, or we'll give you a rebate, whatever, okay? So the option was he had the cash inside of his policy. He could have just taken the cash and gone in and paid a cash offer. Absolutely. Some people prefer to do that because, sometimes, you can get a better price with cash. But in this instance, he went and took a traditional loan through the dealership because of the promo pricing and all of that they had going on. However, once he purchased the vehicle, he is immediately refinancing through his own private bank. So he was able to take advantage of the dealership promotional offer, but refinancing into his infinite banking policy. Here's why he did it. With the traditional lender loan, right, through the dealership, he did a 72-month loan, and with that vehicle, it was $67,000. He got a 5.99% interest rate on this truck. Of course, there's still 72 months left. So what that means is his monthly payment, when he left, right, this is the monthly payment, assuming none of the maintenance fees or anything like that, his monthly payment would have been $1,110.07 per month. Okay. Now, over this time period, he would have paid over 72 months, he would pay $12,925 in interest. So let's make a note of that. So in this, with traditional financing, it's 72 months and $12,925 in interest. Okay? So, here's the thing. Oh my gosh. Okay. I do math, I don't do words. Anyway, so we've got traditional financing, 72 months, and $12,925 in interest. Cool beans. Now, with this policy that he has the $67,000 in cash. It's sitting there in his policy ready to go. Now, what he has opted to do, he's got other money that he's deployed and this and that. He wants to use the cash in his policy to pay for this vehicle so that he's not on this traditional loan terms. Okay. So let's look at what would it be with a policy loan payment. We are going to use the same 6 years as the term length from the traditional loan. Now, here's the thing. If you've been watching, when you take a loan from your infinite banking policy, you are the banker. You make the rules. You decide how much you pay, when you pay, right? All of that. Your payments on your policy loan are completely up to you. However, when you are becoming your own banker, there's a level of financial maturity that comes with being able to take advantage of this strategy. One of those things is being a good banker while also being a good borrower. Nelson Nash talks about if you own a grocery store, don't steal your own peace, right? Like that doesn't make sense. You're not doing anything but hurting your business. You're not doing anything about hurting your grocery store. So when you take a loan against your policy, you have complete and total control over paying that loan back. However, the responsible way to do that would be, let's mimic, if you were going to take a traditional loan and they were going to charge you that anyway, apply that to your own policy loan. And the benefit is that you can pay it off early and save thousands of dollars in interest. Here's my point. If you're doing this, if he's paying into his own policy loan, we set it up so he has the same payment. So he's starting with the same $67,000 loan. Okay, he took out 67, paid off the truck through the traditional lender. So now he only owes that back to his policy. The rate on his policy right now is 5.1%. 5.1% loan rate. Now, what we need to figure out is how much is he paying? Well, let's come over here. He's paying $1,110.07 a month. $1,110.07 times 12 means he is paying $13,320.84 per year towards this vehicle. So let's come back to the policy loan. Here's the policy loan. So we are going to have him paying $13,320.84. Now, does he have to pay this? No. But again, being a good banker means that you're just paying back your policy. Now, before I show you the numbers, don't forget, if you have not already liked, shared, subscribed, do all the things to help promote this video and this channel, it helps us continue to reach more people. So in this, when you have $13,320.84 per year going towards this policy loan, this is what we came up with. Now, on this last year, 8404 is all he has to pay, negative 8404. So what does this mean? Well, okay, at the end of year 5, he only owes $8,400. So what that means is he doesn't have a full year of payment. He actually paid it off early. Let's see how early. We'll say 8404 divided by the $1,110 in payments. So that's 7.5 months. That means that he paid off this loan 5 months early. The exact same payment. The exact same payment. He paid it off 5 months early. And let's see what the difference is in the interest. Well, so if you remember, the interest on the other loan was $12,925. This loan, it is only $8,008. So let's finish this. So IBC policy loan. So it's 60 months, 5 years, plus an additional 7 months. So it was only 67 months, and it was $8,008 in interest. So that means IBC saved my client 5 months, and it saved $4,917 in interest over the same time period, right? The same payment, same time period, all of that. Now, let's factor in one more thing. We haven't even considered this. So now my client has 5 months worth of car payments. So 5 months worth of car payments are now available for him. So let's just factor that in. So the $1,110, let's multiply that by 5 months. So that's $5,550. So that's money that he's able to save because he would have been paying it on that traditional loan anyway. Let's multiply that by, I don't know, let's say he gets 5% on that money, $5,827. So in addition to saving him $4,900 in interest, if he takes that monthly payment towards the car, towards the vehicle, and he puts it into savings, gets, it could be 2%, 5%, whatever. That is just extra money in his pocket, extra money in his business's pocket. That is more money that he has to do what he needs to do in his business. Thank you so much for watching. This was just a quick short video just to address something that my clients are doing every single day. And it just makes me so excited to see them, number one, putting their policy to work. Number two, reaping the benefits of what this policy is doing for them. So again, this was an example of my client. Did he take a loan out? Did he still have interest? Yeah, right? Like these policy loans still have interest. You're still able to write that interest off if you're using it for business purposes, but you are reducing the expense that you're already spending. If you're already spending that money for your business, if you're already doing that to buy something, why would you give all that interest to outside entities, right? Why give $12,000 in interest to the bank when you could refinance that, be your own bank, and you're going to reduce the expense? He reduced his expense. Did he still have an expense? Yes. And don't let people tell you this is free money or that he made money buying a vehicle. Absolutely not. That's not real money. That's not how it really works. Real money is understanding that when we spend that money, we still have an expense. But how do we minimize that expense? How do we recapture the interest? and bring it back into your own compound interest curve. Bring it back into your hands. Bring it back into your business hands. Bring it back into your family's hands. Quit giving it away to all these outside entities. That right? So, with that being said, he saved $4,900 in interest. He saved 5 months on a term for his truck loan by paying the exact same payment. And then if you really want to get into the math, he saved an additional, what, $5,800 by saving his monthly truck payment and getting interest on that. So it's and. So there's all of these multifaceted benefits to it, but it's just understanding why would somebody do this in the first place? That's why we get into the math. Again, don't forget to hit like, subscribe, and share this video so we can continue to spread how money actually works. Until next time, keep it real.